to build a bank that empowers people, ignites ambition, and transforms possibilities into shared sustainable growth and real results. 10 years on, that commitment stands stronger, measured in milestones achieved and lives impacted. From one generation to the next, we've grown together. NCBA is more than banking. It's the trust in your first savings account, the courage to start your own business, the dream of owning your home. We belong to Anguilla, to its people, its families, its future. And as we look ahead, our promise remains to serve, to lead, and to grow with you. Banking where you belong. The National Commercial Bank of Anguilla Limited.
Pleasant good afternoon to everyone. Please stand as we open in a word of prayer. This is the day that the Lord has made, and we will rejoice and be glad in it. Heavenly Father, Lord, we thank you today for bringing us here. Oh God, Lord, we thank you for this opportunity that is given to the National Commercial Bank of Anguilla to celebrate 10 years. It's a milestone, oh God, and we thank you for each year that is celebrated. Lord, we thank you today for this event that has been set out by the bank to enrich the lives of the Anguillan public, oh God, Lord, that as a people we can be stronger in our financial positions and that we can know what the law says and walk accordingly. We thank you, Lord God, for each speaker that will speak today. We pray for clarity. We pray for strength as they share the messages with us, Lord, that we would understand, oh God, and put it into practice. Thank you, Lord, for each person here. We pray, oh God, for those that may be on their way, that they will come here safely. We pray, oh God, Lord, that you'll continue to be with us and that everything that is said and done would be said in decency and in order. May your kingdom come, O Lord, and may your will be done in us as we go forth. In Jesus' name we pray and we say, amen.
Good evening, everyone. And thank you, Vanda, for blessing us with that prayer. By way of establishing a protocol, I would like to recognize the presence of the Honorable Minister for Education, Social Development, Youth and Culture, Mrs. Shelia Rogers Webster, Chair of the Board of Directors, Mrs. Charmaine Vaughn, Director Dr. Justin Ram, Director Mr. I always have to practice his name. I just said Mr. Murillo, yeah? Director Atwana Duncan Van Hennigan, Interim CEO Mr. Jarek Evangelista, other members of the management, members of staff, and everyone, ladies and gentlemen, again, welcome. As we celebrate 10 years of service, it's a pleasure to welcome you all to this evening's panel discussion on two important F's, family and finance, a topic that sits at the very heart of our everyday lives. Whether we are aware of it or not, the financial decisions we make shape not only our individual futures, but also the stability, opportunities, and well-being of our families We promise to make this event informative and interactive. I encourage all of you to listen actively, reflect on your own experiences, and think about the small changes that could make a meaningful difference in your financial journey and your family life. Our Master of Ceremony for tonight's event is Director Murillo. Mr. Murillo is a transformational consultant and leadership development professional, specializing in responsible leadership and institutional renewal. With over 2 decades of experience across the Caribbean and with UK-based organizations, he designs emotionally intelligent leadership programs and embeds performance systems for high-stakes institutions. He currently lectures in both graduate and undergraduate programs in leadership at the University of the West Indies. He has a proven record of guiding public sector and corporate leaders through transformational learning, performance management reform, and culture change. Combining academic insight with practitioner expertise, Mr. Murillo is passionate about enabling individuals and institutions to thrive through evidence-based teaching, coaching, and applied research. His current research on responsible leadership intends to explore the intersection of behavioral intelligence and organizational culture. His presentations include a presentation at the 17th OECS Credit Union Summit entitled, Enhance Member Experience: How Can Credit Unions Innovate to Anticipate and Meet Evolving Needs of Members? Webinars for senior public service personnel entitled, Leading a High-Performance Culture Through Meaningful Relationships in February 23. Applied Action Learning, Building a Customer Service Infrastructure at the Global WIAL Week in September 2022. The Impact of Organization Culture in Creating Smart Organizations at the 39th Annual Conference of the Human Resource Management Association of Jamaica in November 2019, and Revitalizing the Caribbean with Action Learning at the 2019 Global WIAL Conference in Sao Paulo, Brazil in September 2019. His most recent publication in 2024 is titled, What a Difference a Coach Makes in Action Learning, Research and Practice Journal. He's a chartered fellow of the Chartered Institute of Personnel and Development and Global Professional in Human Resources. And he's also a Master Action Learning Coach of the World Institute of Action Learning. So without further ado, I welcome Mr. Murillo to the podium.
Thank you very much, Dr. Harrigan. Minister Rogers Webster, CEO of the NCBA, directors of NCBA, interim chairman, the other staff, senior staff, and ladies and gentlemen, good evening. As we celebrate the 10 years of NCBA, an institution committed to financial well-being and security, it is very fitting that we turn our attention to a topic that sits at the very heart of that mission, the intersection of family and finance. Many people think banking is all about balance sheets and only about balance sheets, but ultimately, banking is about people, households, and futures. This evening we have 4 very powerful panelists who will join me shortly, and what they will do, they will make brief presentations and then we'll have a discussion. So, first off, I would like to call Mrs. Tony Simpson-White of Astafans Chambers to join me on stage. You're here. Yes. Then Mrs. Keisha Fleming Lake, who is founder and owner of her own law firm. Mrs. Charmaine Vaughan, current CEO of Concord Bank Limited and current chair of the NCBA. Dr. Justin Ram, a development economist who is also a director on our board. So the first segment will be on why family financial planning matters. Why is it a big deal? So while money often occupies our attention, financial planning is really about choices, security, and dignity. Someone once said, a big part of financial planning is having your heart and mind free from worry about the what-ifs of life. And for families, those what-ifs are everything: education, health, legacy, and resilience. And to open the batting tonight, Dr. Justin Ram will give us a brief presentation on that. Dr. Justin Ram is a development economist with 30 years of international experience in 34 countries, spanning the Caribbean, Africa, Latin America, Central Asia, and Europe, with practical advisory, research, and management experience with governments and many multilateral agencies, including the IMF, World Bank, Inter-American Development Bank, CARICOM agencies, and several United Nations agencies, as well as private and public sector firms, including Worley Parsons, Jacobs Engineering, Sasol, and Petronas. He was the program director and lead advisor to the Premier for the National Delivery Unit in the Turks and Caicos Islands government. He was responsible for operationalizing a delivery unit in Turks and Caicos and implementing the government's priority projects and policies. Justin has a diploma in executive management from Stanford University and a PhD from the London School of Economics and Political Science. Ladies and gentlemen, I want you to welcome warmly our first panelist, Dr. Justin Ram.
Thank you very much, Chairman, Minister, my fellow directors at NCBA, the interim CEO, Jerick Evangelista, my fellow panelists, and of course, ladies and gentlemen, it's a great pleasure to be here with you. It's actually my first time back to Anguilla for about a decade. And what's funny about this is that the last time I was here, I was working on the reorganization of the couple of banks that then became NCBA. So to see NCBA after 10 years and what it has become is really quite heartwarming for me, because I know where we came from. Now, my task this evening is, of course, to just give you a bit of an idea as to why financial planning is so important for families. So I'll just ask the technical team to cue my presentation. Now, when I was asked to do this, I started to think about how should I pitch this to you? And I thought that perhaps the best way to do this is to speak about a sort of a life cycle approach to financial planning when it comes to families. And so hence, this is my first slide, which shows you what I think is important for us as families to think about when we are planning our financial futures and for all the various steps in life that we must be cognizant of as we walk through this. So it's one family, but there are multiple timelines competing for financial priorities. That's critical for us to remember. Yes? Next slide, please. Well, I have this. So, I'm hoping I can use this here. It's on? Yeah. So this slide here really gives us an idea of the Caribbean family, as it were, and all of the competing financial needs of that family. So we might have a father within that family thinking about, maybe I need to plan for my career, do an MBA while I'm working. There's a mother in there as well who has to balance so many things with respect to her own career, but also managing the family as well, health and wellness, and of course thinking about retirement savings. Then in that family there might be a teenage son who is quite eager perhaps to go off to university. And so the family has to also think about how we put aside resources for that education. And then of course there's a young daughter in those early years and what she might be thinking about and what we have to think about as parents for that young child. And of course, I thought it was really important for us to consider that in the Caribbean, the family is really not just a nuclear family, but it's quite extended. And at some point in that nuclear family makeup, we're likely to have our dependencies growing because as grandparents become older, we might have to start taking care of them. And so the idea within this slide is for us to think about all of these possibilities and to start thinking about them early and to start planning. So it's really about a financial plan, is a roadmap that connects resources, goals, and timelines across generations. So what this family must manage simultaneously is here. Managing the daily expenses, planning for the education of these two children, building key assets as they were. How are we going to finance the purchase of a home or the building of a home or even the transport that's required for that home? Secure retirement after our working life. Preparing for emergencies. And the time for preparing for emergencies is not when the emergency happens, but it's thinking about these things well in advance. We don't want to have emergencies, but these things happen in life. And so we plan for it if that might happen. And of course, we all want to enjoy life as well. Life is not only about working and planning for emergencies or for education. It's about also having money to enjoy the leisurely things in life. That's also going to be important. I did not include it here, but I think it's also important to consider that in emergencies, we might have older parents coming to live with us. And so at some point in our family structure, there might be an extended family, and of course, that means that there's going to have a pull on our resources. And I think it's really important for us in the Caribbean to think about how we start planning for that well in advance. So as I thought about doing this presentation, I thought it was really critical for us to think about the entire life cycle of a family. And while I've spoken about a lot of these things, I also want us to be cognizant that there is also an end-of-life planning that we have to think about. Because often we might, and this is of course a fact of life, we don't want to leave our families with a burden after we have passed away, for example. And these are things that we have to start thinking about. Are there insurance products that we can put in place if there's an untimely death, or even when we get to that age when we're expected to perhaps die, that we have put things in place so that our families are not burdened by our own death. So I've tried to think through here this entire life cycle for us as we consider financial planning, from conception and prenatal care to early childhood, adolescence, building the family, the pre-retirement time in our lives, then retirement, and of course that end of life as well. So let's think about conception to birth and preparing before costs begin. What are we considering here? Prenatal care and medical coverage. When families are thinking about having children, these are some of the things that we have to consider. And we have to consider what type of financial actions are going to be required. Perhaps you might want to review our health insurance, build in liquidity buffers, because as we have children, we are likely to now have times when we're not working. And our incomes are not going to be as high as when we are working and taking care of the children. And we have to be able to adjust household budgets for upcoming children. So insight here is really about the first financial decision starts before the child is actually born. And what about early childhood? Here we tend to have high recurring costs as we tend to have young kids within the family. So we think about what are the key financial needs here. Childcare and early education is going to be important for us. The nutrition and the health care of the family, as well as the daily living costs of the family are going to be critical. It is in this time of a family life cycle when we expect our recurring costs to be quite high. And so it's really important that we start planning early for education through some type of a savings fund, as it were, because these children are, of course, going to grow up and want to go off to a university or some type of education, or even maybe an apprenticeship, where now families are now going to have to pay for that as well. So the insight here, costs are frequent and not one-off, and we have to start thinking about that carefully. And of course, during adolescence, education becomes a major investment that we have to consider. We have to consider tuition and school-related costs, the extracurricular development of the child, and technology and skills investment. I have young kids, and I have kids who are now studying at university abroad, and I tell you, every time I see that message coming up on my phone, I'm saying, I know this is not just about Daddy, how you're doing. This is about Daddy, I need this. And you know, it's really important that I've planned for that so I know that these eventualities are going to come. Dad, I want to do this. I want to join the society at university. Can you send me some money? You know, I know that. Although I've planned for their education, there are always some additional costs coming up. I have to be able and willing to, of course, satisfy that. So the insight here is education spending peaks before income generation begins. That's important as well. And what I'm trying to say to you is that while we are doing this in our families as parents, we have to also pass on this information to our children. So it's really important for me now to pass on to my 20-year-old daughter and say to her, you have to start planning from now to do the things. Think about saving for that first home purchase, for example. Do it earlier rather than later. Early adulthood, the foundation years. What are the key financial needs here? Living expenses and independence. And again, I have a really nice example of this. Just a couple of weeks ago, I was speaking with my daughter about this. And she was saying, you know, Dad, and well, she's studying in the UK. Say, Dad, you know, my friends and I are thinking, are we ever going to be financially independent? Are we always going to have to be living at home? Now, immediately she was thinking of, well, there's a certain career path that she wants to take, but she's thinking that might not provide a type of income that requires her to gain the independence that she requires. And so now what she's thinking about is perhaps doing something initially to gain some more income so that she can then gain the type of independence. And I think it's really important for us to remind our kids about what's important for them and for them to work towards that in part of their financial planning and in their education. So in the financial actions that are going to be important here for us, we have to remember we have to control our lifestyle inflation here. I'm always saying to her, well, you can't do this, you have to be mindful, you can't be spending wildly. Build savings discipline and begin long-term investing. The insight here really is about financial habits formed here determine long-term outcomes. I think that's going to be really important for us to be reminded that in this family life cycle approach, this intervention that we can make for our young people to say to them that if you build in discipline now, this is going to rebound to your benefit later on. Now you have this building of the family and you have the peak financial pressures which I've spoken about. And one of the major things that we go through in families is that we want to purchase that home. We want to build up our assets, yes? So here we're speaking about asset purchases, not only the homes, but perhaps a motor vehicle. We live on a beautiful island here. Some people might want to purchase a boat, for example, or even a yacht at some point. So how do we plan to do these things? And of course, we still have children's education to take care of. And what's important here, I think, is that during these peak times when our financial outlays might be quite high, we have to plan for emergencies. And so it's not only important to save, but it's also to think about what types of products can protect us if an emergency occurs. And so I have here insurance protection as well. What are the financial actions that are going to be required? Increase savings rate, diversify investments, and balance our consumption and long-term planning. What's the insight? Multiple obligations converge in this stage of the family life cycle. Then we go into pre-retirement, the risk management phase, as parents are getting to that point and maybe children are going off. Then, we're getting to that point of empty nesters, as it were. We have to think about planning for healthcare, debt reduction, and being ready for retirement, whatever that might mean. I don't think we ever want to go into a state where we're just at home. We might want to have resources to allow us to do the things that we were not able to do while we were taking care of the children. So planning for that travel, that around-the-world trip, for example, might be useful here. So what are some of the financial considerations here? Consolidate assets, reduce exposure to risk, and finalize retirement strategy. An insight here, of course, is recovery time is limited. Decisions must be precise. Now, of course, we get to that time in the life cycle where we need to retire. There are key financial needs that we have to consider. What are the products that we are going to use to ensure that during retirement, we have a stable income to rely on? So we have to be mindful of managing withdrawals carefully, preserving capital, and planning for longevity. The risk here shifts from earning to sustaining. Because as you're going to retirement, your income decreases, and you want to ensure that you have enough savings to maintain the type of lifestyle that you would have and want to have during retirement. End of life, final financial responsibilities. And here, this might sound like a topic that we don't want to speak about, but I think it's very important. Because in my career, I've seen many families who have gone through this and have not planned for that end of life. And that has meant a lot of burden for those who have been left behind. I think it's important for us to consider what sort of financial planning that we can do to ensure that those that we leave behind are not burdened by this, yes? So prepare a will, structure asset distribution, reduce administrative burden on family. Recently, I got some really good advice from a lawyer who said, Justin, you may not even want to consider doing a will because that takes up a lot of time for the assets to then be distributed. It might be useful that during your lifetime, you actually now, in particular assets, have joint ownership of those assets. So for example, if you know that, okay, I really do trust this family member, maybe have them as a co-signatory on your bank account. Perhaps place that family member on the deed so that if in the event that something happens to you, that asset passes quite easily to them, rather than through a will, which can take a lot of legal costs and a lot of wrangling and time before that asset actually passes on to those that you love. Just something for us to consider. Insight, planning reduces financial and emotional stress here for survivors. So again, just to bring it all together, it's really important for us to consider as a family what are the things that are going to be important for us and to start planning for that. Living expenses, education, saving for that asset building time in our life, retirement, emergencies, leisure and quality of life, and of course that end of life period as well. And so with my last slide here, I think it's really important for us as we think about each of the different phases in our life cycle, what are the type of products that we might want to consider? For in here, on this last column that I have here, I have indicative financial products to consider. Liquidity and savings, some type of savings products, fixed deposits, insurance as well, growth and investment. There are stocks, mutual funds, again, insurance. We can also even think about how we boost our income through perhaps other employment and self-employment, as it were. So while we might be working, there might be other things that we can do to boost income during that time when our outgoings might be quite high. And of course, when we're thinking about financing assets, we have to think about what types of products we can come to a bank to ask about. Mortgages, loans for productive assets, even if we were to start doing our own business. And of course, I want to ask you to consider, while you are working, take some time and learn about the stock markets, see where you can perhaps invest and make your money work and grow for you. I see a lot of young people in the audience here. It is much better for you to start earlier rather than later. Learn about the stock market. Pick up that Financial Times, read it, and get to understand how you can perhaps invest in stock markets in the Eastern Caribbean, or invest in the US or even in Europe, where you can make a return on your resources. So with that, that's just an idea, a life cycle approach to managing your family and, of course, your family financial planning needs. Thank you.
Thank you very much, Dr. Justin Ram. Thanks for that. I didn't hear a lot of applause. Can we just give that's better. Right. So what I'm going to do, each of the panelists will do the presentation, then I'll have them have a little interaction among themselves to see if there's a nexus between certain topics, and then the audience, you'll have a chance to ask your questions. Yeah. So every family has a financial story, but not every family has chosen to rewrite that story. In a financial makeover, you're not looking for perfection. You just need to make progress that is intentional. And as Dave Ramsey says, a budget is telling your money where to go instead of wondering where it went. Tonight, we explore how families can move from reacting to planning. We're doing that under the topic balancing family, business, and financial goals. So, and to cover that with us is Mrs. Keisha Fleming Lake. And Mrs. Fleming Lake is the founder and managing partner of Keisha Fleming Lake, LLC, a boutique law firm specializing in intellectual property and corporate law across the Caribbean and the United States. With over 25 years of legal experience, Keisha has built a distinguished cross-border practice advising clients on trademark protection, corporate structuring, regulatory compliance, and complex commercial transactions. Keisha began her legal career in the United States, where she worked as an associate with a major U.S. law firm, gaining experience in corporate, immigration, and commercial matters. She later served as in-house counsel with the Missouri Department of Social Services before returning to the Caribbean to establish her own practice in Anguilla in 2006. Since then, she has developed a highly respected practice, providing legal and corporate services to both local and international clients. In 2023, she expanded her firm's footprint with the establishment of a satellite office in Florida, further strengthening her cross-border capabilities. Prior to founding her current firm, Keisha served as managing attorney at Caribbean Trademark Services, where she led intellectual property portfolio management across multiple jurisdictions and supervise legal teams handling regional trademark matters. Her practice today focuses heavily on the management and protection of intellectual property, portfolios, strategic legal advisory, and the development of tailored legal solutions for businesses operating across jurisdictions. Keisha is admitted to practice in Anguilla, Antigua and Barbuda, and St. Kitts and Nevis, and is also licensed in multiple U.S. jurisdictions, including Florida, Michigan, and Missouri. Her qualifications and experience allow her to advise on matters across the English-speaking Caribbean and the United States, making her a trusted advisor for clients with international interests. She holds a Master of Laws, LLM, in Intellectual Property Law from Western Michigan University, Cooley Law School, a Juris Doctor from the University of Detroit Marcy School of Law, and a Certificate of Legal Education from the Eugene Depok Law School. She's an active member of the International Trademark Association and the Intellectual Property Caribbean Association. Keisha is known for her strategic insight, client-focused approach, and commitment to excellence, and she continues to play a key role in advancing intellectual property protection and corporate legal services throughout the region. Ladies and gentlemen, I'd like you to warmly welcome to the podium Mrs. Keisha Fleming Lake.
Good evening, everyone. I adopt the protocol already established, and I wish to recognize the presence of the minister and to the other banking officials. Before I begin, I have to give a brief disclaimer. I do not hold the extensive resume as my previous speaker in banking, so I don't stand here in any way, in any shape or form as a banking expert. I come before you from my experience in my life. And so today I've tailored my presentation using my life experience as a family person, a businesswoman, and someone who tried very diligently to stick to the life cycle planning that was outlined for us before. Now, that plan, of course, spans from birth to death, your entire life. So we're all, at some point, is in some shape or form part of that cycle. My role today is to demonstrate how we balance what life brings to us as the head of our family or just being a family person, as a career person or a business person, in our pursuit to achieve the goal of the life cycle that was so pleasantly and eloquently outlined to us earlier. So let me begin by asking a simple question. Oh, and one other disclaimer. I have no capability of managing slides. Sometimes I'm on the right slide, sometimes I'm not on the right slide. I'll try my best to keep up. But if I do, if you find me on speaking about a topic that's not on the screen, just focus on what I have to say. Don't worry too much about the screen. Okay? So I have a very simple question to ask. Have you ever had a week where everything was planned perfectly, your calendar was organized, deadlines were scheduled, goals in motion, and then suddenly life changed those plans? Not in a dramatic way, but in a way that was enough to shift your priorities that you had laid out. Most people are prepared for success. Very few of us are prepared for interruption. And yet, interruption is such an integral part of life. Today, I want to talk about what happens when three major responsibilities of our lives collide together: family, business or career, and financial goals. Because in my experience, at some point, whether it's at the beginning, at the middle, or at the end, these three things overlap, and they cause significant stress. I am currently navigating one of those seasons. there is an important family matter that's requiring my presence, my attention, and my time. It's not something that's catastrophic or life-threatening, but it is significant enough that it must come first in my life right now. At the same time, as you heard in my bio, I run a very demanding legal practice. I carry significant business responsibilities, and I still have my financial goals and my commitments. But those don't pause. When life has become complicated for me, I have to ask myself, how do I remain committed to my family? How do I remain showing up for my business or for my career? And how do I find the money and the resources to continue with my financial goals? But that question, I'm sure, is not unique to me. I'm sure at some point, all of us have to ask ourselves, do we put this money into the savings account today, or do we use it to purchase that book that my child is asking for, that laptop that suddenly stopped working, that cell phone that all of a sudden can't do what they want them to do? Many of us face those questions, and then we have to ask, what do we make priority? What do we do right now with that specific amount of money that I had saved and planned for my financial goals? What do I do about going to work that needs me, that business that needs me constantly to be showing up, that's taking all of my energy, but yet there is something that's so important in my family that needs me to be there? So my presentation that I'm going to give is not based on any of my legal training per se. It is from my perspective today. It comes from my experience through my years of being a business leader with professional responsibility as being one of the heads of my household, my responsibility as a wife and a mother of 3 children. And it also comes from me growing up in a home watching resilient parents build meaningful lives under pressure with far less resources. And from watching my parents and living my life, I want to bring to you my presentation, because in reality, there is no perfect balance. We want to make it balanced, but there is no perfect balance. But there are basic principles that can help us through difficult seasons. Slide 4, I think I'm on. So there's a central message that I'd like to talk about today. There is no permanent state of balance. We want to achieve balance, and then we get happy and we get very comfortable, and we want that balance to be maintained. But balance is dynamic. It shifts, it adapts, it evolves, which means that our real objective then is not balance. It is how we align our values, our responsibilities, and our decisions in any given moment. And there are 3 main pillars that I find to be important that I want to share with you in my 20 minutes. The first pillar is clarity. One of the greatest sources of stress is trying to give equal attention to unequal priorities. That is impossible. And yet, many intelligent, capable people judge themselves harshly. In fact, we are oftentimes our greatest critics when we cannot do the impossible. There will be times when our family comes first. And there will be times when our businesses or our careers require us to be present. And there'll be time when we have to be financially disciplined. But that doesn't mean if you focus on one instead of the other that you're failing. What it means is that we have to develop an understanding of timing. What timing are we in? Balance is not an equal distribution. It's an intentional allocation of where we're going to put our time, our energies, and resources given a particular time. As a leader, as a family person, as a career person, we have to ask ourselves, what matters right now? what requires my attention right now? What can wait without significant consequences? What can wait without taking us off of our financial goals? Clarity and understanding of these things helps to remove the guilt that we feel, because guilt is one of the heaviest burdens that we can carry. A second pillar is systems. It's actually one of my favorites because it's one that in my situation, in my season right now, is helping me navigate. Many people are overwhelmed because they have too much responsibility. And I will repeat that. Many people are overwhelmed because they have too much responsibility. There is a saying that the reward for good work is more work, which means when you become good at what you do, you're given more tasks. But when you're overwhelmed and everything depends on you personally, that's not the time to panic. If the operation or if your job or your task or what you're doing stops, when you step away from doing that, from being in charge of your business or being in your seat to go focus on your family or to focus on your financial goals, if that starts to fall apart, that is not strength. That is a fragile situation disguised as important. To sustain success, it requires delegation, my favorite word, process, communication, and very clear communication, financial structure, and people that we can trust. Leadership is not proving that you can carry everything yourself. Leadership is ensuring that things don't collapse when you cannot be present to do your job or be for your family. Strong systems allow us to be fully present when we are not there. Whether it's at home, whether it's the business, whether it's in your career, you have to learn to delegate. And let me emphasize this point, because sometimes I feel like I'm a control freak, because I panic when I don't know how it's going to end up according to my plan. But delegation is not loss of control. Delegation is an expression of trust in the persons that you delegate to, and it's a representation of maturity that you've developed the confidence to be able to delegate. And this plays out in any scenario, whether it's in your job as a career person, whether you have a business and you build a team that's working with you and you have to delegate certain tasks to that team, or whether it is that you're in a family situation and the wife has to delegate some responsibilities that she's used to carrying to the husband, or the husband to the wife, or even to an older child, or to a sibling. In any situation, the task that you're used to be carrying on a consistent basis, when you're faced with finding that balance, being able to delegate with maturity and trust is very important. The third pillar is perspective. Short-term disruption often creates long-term mistakes. Why? Because stress narrows vision. Stress focuses your mind on the stressful situation, and it eliminates all the other things. The need to be financially prudent, the need to be present with your family, the need to show up to work, the balance that's necessary. Stress takes that away. Why? Because people panic, they overreact, they abandon plans. I'm under stress, so I don't need to be focusing on my financial goals. I'm under stress, so my family shouldn't expect for me to show up. I'm under stress, so I'm calling in sick today. They abandon the plans that's necessary for the balance, and they assume that if you delay one area and focus on the one that's important, you're defeated. But a delay is not defeat. What a delay demonstrates is intentional maturity to create that balance that has been lost in the given situation. A slower quarter of production is not a failure. A postponed plan to a vacation, a family trip, a postponed plan to make a savings this month is not a collapse. A difficult season that we all may experience at some point or the other, I just described that I have one, is not the end of your story. Temporary disruption is not a permanent failure. The most important people understand pacing with intention. They know when to accelerate, and they know when to stabilize. They know when to pause the strategy. And most importantly, they know how to remain committed to the vision even when timeline changes. So to put it into a financial perspective, even when there are times when we cannot focus on our financial plan or may not be able to be present at work the way we need to be, we understand the importance of coming back to this and accelerating, slowing down, and pivoting as is necessary. I always like to end my speaking presentation with practical actions. I always like when people leave the room after I've spoken that they have a plan of action. And so today I'm going to give what I consider to be practical actions. Now, this is coming from me. First, when life becomes demanding, first thing we need to do is refocus rather than react. It is so easy to react, overreact, and end up heading in the total opposite direction. I've done it. Thank God I have some people in my life who are here in the audience today who easily put me back on track. Adjust plans with intelligence, not with emotion. Second, simplify aggressively. Now, simple and aggressive seems like two opposite words, but understand what I'm saying. You have to simplify the situation in a very aggressive manner. In other words, hurry up and slow down. Separate what is urgent from what is merely loud. Remember, the stressor is always the loudest, but it may not be the most important. So we have to learn to figure out what is urgent, what is important, and what is loud, and put it in perspective. Third, protect your core commitments, your family values, your job or your business, your financial planning. You have to protect those things. Your reputation, family discipline, financial discipline, is still important. Health is still important. Health without wealth is zero. Long-term direction. We heard from our previous speaker that you're starting from birth all the way to end of life. My father is 92. He's still working. So if he's been planning from zero, he's been planning for 92 years, and he's still planning. That's a lot of time. And if you meet him today, he will tell you he's still planning. As a matter of fact, he will tell you he's on borrowed time. I don't know whose time he's borrowing, but he will tell you he's on borrowed time. In other words, he feels like he has a lot of time left. So we cannot forget our long-term direction. Fourth, we must communicate clearly. It is so easy to call words and say, I told you, and the other person you've spoken to have no idea what you've said because you have not communicated clearly. So it's so important, whether you're speaking to family, whether you're speaking to clients, your co-workers, someone dealing with your health situation, or someone on your team, your financial planner, communicate clearly. And fifth, remember that the momentum that you've had or you want to have can be rebuilt. Panic decisions are often more expensive than temporary slowdowns. So I'm going to bring it all together. And I think I'm within my timeline. When pressure rises, we turn to these three pillars: clarity, systems, and perspective. Clarity tells you where to focus. Systems give you the support that you need. Perspective keeps you steady. Together, they create the resilience that you need. And resilience is oftentimes way more valuable than raw talent. Talent shines easy in certain seasons, but resilience sustains success through difficult ones. So let me close with this thought. At some point, every person in this room will be filled with a season where life takes more of you than feels convenient. Your family will need you, work will need you, and your financial goals will still matter. The question is not whether pressure arrives. The question will be how you respond. How do you create that balance that's not possible to be maintained? Will you panic or will you prioritize? Will you carry everything yourself, or will you build systems with trusted people and delegate some of the immediate tasks? Will you lose perspective under stress, or will you stay committed to your long-term gain? You should not have to choose between being present for your family, your successful career, and your financial goals. But what you have to do, or you should do, is you must be intentional about how you navigate between the three. And often, the strongest move is not pushing harder. It is adjusting wisely all the time. Thank you.
All right. Thank you very much, Mrs. Keisha Fleming Lake. Mrs. Fleming Lake did a great job of pointing out to us one of the greatest tensions in modern life. So we try to build businesses to support our families, but while we're building the business, we sometimes risk losing that whole balance along the way. Some nuggets I got: stress narrows vision as you're juggling all those priorities. And I also picked up simplify aggressively to calm those stressors. And also we had the 3 pillars: the clarity, systems, and perspectives. And it reminded me, the presentation reminded me of Stephen Covey, who said at one point, the key is not to prioritize what's on your schedule, but to schedule your priorities. So once again, let's give Mrs. Fleming Lake a round of applause. At this point, we turn to 2 subjects that many of us try to stay far away from: money and law. But the sad truth is that those 2 things are what will shape our legacy and what we leave behind. And Warren Buffett said at one point, someone is sitting today in the shade because someone planted a tree a long time ago. So financial and legal planning is that act of planting, ensuring clarity, protection, and continually for those who come after us. And to present us with the financial and legal matters affecting families, we have Mrs. Simpson White, Mrs. Tonne Simpson White, who is with the Astafan Chambers. And Mrs. Simpson White was called to the Jamaican Bar in 2014 and the Aguilar Bar in 2019, having obtained a Bachelor of Law degree with honors from the University of Technology, Jamaica, and a legal education certificate from the Norman Manley School. She is also certified in risk management. Her years in practice have been spent in leading and supporting roles in criminal, civil, and commercial litigation matters. Mrs. Simpson White's commercial experience includes acting on behalf of financial institutions, insurance companies, investment companies, property management companies, and construction companies. Her areas of practice cover a broad array of litigation matters, including property claims, constitutional claims, debt collection, labor disputes, and contractual disputes. Prior to joining Astafan's Chambers, Mrs. Simpson White was a legal counsel in the Group Legal and Corporate Services Department at Sagicor Group, Jamaica Limited. which provided legal services for all companies under the group, including Sagicor Life Jamaica Limited, Sagicor Bank Jamaica Limited, Sagicor Investment Jamaica Limited, Sagicor Property Services Limited, and the 4 hotels that were owned by Sagicor. Mrs. Simpson-White played a pivotal role in the creation of the Human Resource Manual for the hotels and in advising the different entities on labor-related and personal injury matters. While at Sagicor, Mrs. Simpson-White prepared mortgage documents, leases, sale agreements, and service contracts. Ladies and gentlemen, I want you to warmly welcome to the podium Mrs. Tonne Simpson-White to cover financial and legal matters affecting families.
Good evening, everyone. Hopefully, I'll be able to manage the clicker. Now, I have the pleasure of presenting the topic of financial and legal matters affecting families. Now, this is a very important topic. And it may be a bit boring, so I'll try not to bore you to death with it. There are a few core areas that I intend on focusing on because over my years of practice, I realized that a lot of the disputes that we have to deal with at our chambers surround that particular area. Now, for most families, what they seek to do or one of their core obligations or one of the duties is the creation of stability, security, and freedom for their families. And a lot of families believe in obtaining this or believe the way to obtain it is by acquiring property so that they can provide shelter and a home for their families. Now, before doing so, you need to have a full and frank conversation with all of the adult individuals who you intend to live on the premises. This is very important because a lot of the disputes always surrounds property, what the legal interest should be in it, and what is the beneficial interest to be in it. So you need to sit down and prior to acquiring the property, have that conversation, yes? Now, those needs are normally satisfied through financial assistance, through financial institutions such as NCBA. And not all of us have the benefit of being left or being given property from our families and such. So we have to rely on the bank for our assistance. Now, this is where finance, law, and family tend to intersect. The acquisition and division of properties. Yeah, trust me. This is where a lot of it intersects. Now, for those who are considered the providers in their family, in acquiring the property, you need to think about what your intention is at the point of acquisition, right? Think about the adults who intend to live on the property, what beneficial interest they will hold in it, and have that discussion. Once you have that discussion, you need to go ahead and document it. Get independent legal advice on it from the very beginning before you take any further steps. Now, this will prevent a lot of misunderstanding between the members in the household as to what they believe they would be having in terms of their interest in the properties. Now, part of that discussion has to be focused on how the acquisition is going to be financed, who will be financing it, and importantly, like I said, the interest in it. Now, what a lot of people don't realize is even if you're the legal owner of the property, if someone assists you with financing the property, such as maybe paying the mortgage or helping you with the construction costs, that sometimes results in them getting beneficial interest in your property. So if you do not intend on conveying or parting ways with your beneficial interest, it's best you discuss it in the beginning, document it, and sign an agreement to that effect so that there's no misunderstandings. A lot of times you see, including between spouses, where one spouse might be paying the loan and the other spouse say, hey, I will cover the rest of the expenses. And this is where it gets tricky. Because a lot of times the understanding or what the belief is that, well, I'm covering the other expenses just to allow you to pay the mortgage, but I am supposed to have some interest in it. And it's not documented anywhere. And in happy times, it's all fine and dandy, right? We're happy, we're in love, everything. It's in the back end when there is some sort of stress or strain on the relationship and you're getting to, sadly, maybe a possible divorce, that you realize that you're gonna have disputes about this property. So, like I said, document it, get your legal advice and everything. No. Even if you own the property prior to anyone living on it, or prior to any construction on it, still have that full and frank conversation. It will save you a lot of pain in the end. It's always good to document it nonetheless. Because as I've said earlier, let's say for instance, you had a property, a piece of land prior to getting married, and you decide that you're gonna construct your home on it, and your spouse contributes to it. That in and of itself, even if she's not the legal owner or he's not the legal owner, gives them an interest in your property. And if that's not your intention, you need to make this abundantly clear from the very beginning. Seek legal advice nonetheless. And even when they're not contributing directly to the property or its construction, it's still best to document your intentions. And I'll tell you why. I've seen a case coming from the House of Lords in particular where a wife spent £40,000 on the house that was acquired by her husband. And during divorce proceedings, she's saying, well, I have interest in it. I gave him £40,000. That was what it was for the renovation of the property he purchased. And the court said, no, that was what was expected of you. You were living on the property for many years, so you got that benefit of it. You didn't have any interest in the property. And this is why I really, really implore you. Yes, the conversation might be tough. A lot of friction may be had if you go ahead and do it, but still have that conversation and document it. It's better to discuss it now than end up in a big fight later, because trust me, I don't mind getting the money, right? The thousands of dollars you'll have to expend in legal fees. But it's better to just deal with it in the beginning than dealing with it in the back end, because what will happen is the court will have to listen to the evidence. And when it's not documented, it's a bunch of he said, she said situations. And then the court has to listen to the he said, she said, and try to figure out who is telling the truth, who is not telling the truth, try to look at your actions to see what maybe was the intention in respect of the beneficial interest of the property. So it's always best to just document it. Get your legal advice. Do it before, don't do it in the back end. Now, once you acquire the property and you provide this shelter for your families, you need to honor your obligations to your family by making sure that you don't lose the roof that's over your head. For those of us like me who have to take a loan, that's fine, nothing is wrong with that. Honor your obligations to the bank and honor your obligations to your family by ensuring that you make your regular payments, you maintain your life insurance policies, you maintain your property insurance policies as well. Now, a lot of people don't realize that even if you pay the mortgage and you don't pay the life insurance and property insurance, you're still in default. And if the bank so chooses, they can still sell your property once it's a special covenant in your loan agreement. So just ensure that you keep everything up to date, don't let anything lapse. The life insurance policy is not just for the bank's benefit, it's really for your benefit as well, including the property insurance. The property insurance, as I said, this is key in planning for your family's security and stability, right? Let's say, for instance, a hurricane comes, your house is damaged. At least you have the property insurance to repair the household. If you don't have it, then you're gonna have to really come out of pocket. It's gonna put more financial strain on you, and you don't need that. Because you know a lot of financial issues lead to divorce in marriages. So let's just do what we need to do. The life insurance policy. Yes, it's good for the bank, but it's also good for you as well. I have seen many instances where the borrower is now deceased, the family now does not understand, like, how are they gonna make the payments on the loans, if they can make the payments on the loans, and the bank is still forced to sell your home. So just keep your life insurance in place. It's good for you, it's good for the bank, it's good for everyone. Now, a key part of planning for your family and where the law and family and finance intersect is in your estate planning. Now, you need to ensure you have a will, and I'll tell you why. Even if, let's say, for instance, you have someone on your bank account as a joint bank account holder, there's actually a case out of the House of Lords where they said that because they're a joint owner does not necessarily mean that the money goes to them upon the other party's death, right? The court said you have to look at, once again, the intention of the parties when they created the account. So always be mindful of these things, because there are always arguments that, okay, well, that person was just put onto the account for easy access, just to assist, not because they're supposed to have beneficial interest on the account or with the monies in the account. So once again, it's always best to ensure you document what you intend. Now, with the will, it ensures that whatever assets you own, whether real or personal being your cars, your jewelry, all of those things, how it will be distributed. Because if you leave it to the laws of intestacy, what will happen is the law will determine how your assets is distributed, and that may not be what you intended. So a will also reduces the likelihood of there being any members of the family fighting over any property. We know we see this a lot in Angola, where someone dies and everybody rushes to try to claim some ownership of the property. So a will reduce that. And it also allows you to protect your minors and your dependents, because you get to decide who may have care of them, who will hold the monies on trust, and all of that. Now, in selecting the executors of your will, please pick somebody who is trustworthy. We have cases in the court where the administrator or the executor decides that, well, they're not going to give the person the property. They're just going to register it in their names. We see that a lot here in Angola. So pick somebody who you know will look out for your dependents, look out for your beneficiaries in your will. Now, a part of estate planning and long-term planning, and this is also where finance and law intersects, is in the creation of a power of attorney. It's really a useful tool where you get to dictate, let's say, for instance, when you're incapacitated, who will make decisions for your health, who will have access to your bank accounts, because, it's a financial institution. There are confidentiality issues. They can't just allow people to access your bank accounts, allow them to access your banking information. So by creating a power of attorney, this is actually a very useful tool for you, even if you're off island, and you get to limit exactly what that person can do. So if you just want him to make decisions in respect of your health, if you're incapacitated, there you go. You go and get a power of attorney for that, yes? Now, in conclusion, you need to ensure you do financial planning. Your financial planning must include your savings, your life insurance policies, because these are good benefits in the end. Let's say, for instance, not just when you have a mortgage, but you die. At least if there's an insurance policy in place, your beneficiaries can pay your debts, yeah? Cover your funeral expenses. They don't have to be running around trying to figure out, okay, where am I gonna get this money to bury you? How am I gonna afford this? How am I gonna afford that? How am I gonna pay John Brown that you owe? You'd have the monies from the insurance policy. Now, as I said earlier, always discuss your intentions in respect of property, seek legal advice, and make sure you document it. So that way, at least the court has some documentary evidence as to what was intended. Now, you should also ensure that your debts are paid. Always try as much as possible to keep it up to date, because even if you don't have a mortgage on your property, and let's say, for instance, someone sues you, get judgment against you, they can apply it to the court to sell your home if you have no monies to pay them, and therefore you'd lose your stability, your security. So just ensure that your debts are also paid. And plan for your future and plan for your dependents' future. Like I said, with the insurance policies, those are always useful tools. Some have investment riders that allows you to get some money during your lifetime, if anything. But just be mindful when you're into any agreements with anyone, when you're acquiring property, whether it's a car, anything. Just pay attention to what you're doing, document it. I know it seems repetitive, but majority of the problems Anguillians face in their families all surround disputes over properties. And it all happens because no one took the time to document it and ensure that things are done properly. Well, that is the end of my presentation. I told you I would hope that I don't bore you to death. You look half bored. Yeah, you look half bored. That's okay. I knew it would happen. It's not the most exciting topic. It's not. But it's a very important topic because I think a lot of us don't understand what we do in our families, even where we make promises to, let's say, your brother that, listen, bill over here. When I die, you will get it. That's binding, even if you don't even put it in your will. Because once they acted on that promise or that assurance you gave them, they now become the owner, yeah? And even if in your lifetime you want to eject them off the property, you cannot. So be very mindful of your dealings at all times when you're dealing with property. Be mindful of it. So I'll leave you now. You can wake up, and I'm sure Mrs. Vaughn will bring you back to life, right? Yes.
Thank you very much, Mrs. Tony Simpson-White. Yes. So we have, and tonight is not a theoretical conversation we're having, it's practical. So we had to have the foundation, you know, from the people in the field. But after I'm hoping you have questions that are very practical, you know, is what is directly affecting you so that the panelists can answer. So we've done the wife family financial planning matters, looking at the life cycle and see how we work through that. We've looked at how we manage the tension between building our family business, building our business, building our family at the same time, and how we manage that. And Mrs. Tony Simpson-White just dealt with the two usually vexing issues, money and the law. At this point, again, we want to look at how do we tell our money where to go instead of wondering where it went. And that, to do that, we will have Mrs. Charmaine Vaughan. Mrs. Charmaine Vaughan is the CEO of Concord Bank Limited. She is a well-respected senior banking professional with over 25 years of experience in the banking industry. She has extensive regional banking experience, having worked in several markets in the OECS, Barbados, and Trinidad. She has worked in every facet of banking, including retail, corporate banking, wealth management, and investment banking. She is renowned for her strong leadership in transforming a local bank in Anguilla, from a bridge bank into a sound and profitable institution. Earning recognition as an award-winning bank among Eastern Caribbean Currency Union banks. Her strategic leadership also earned her the prestigious Corporate Leadership Award from the St. Lucia Chamber of Commerce in 2012. Her board-level experience includes serving as a director of the Eastern Caribbean Home Mortgage Bank, the Anguilla Chamber of Commerce, the Caribbean Credit Card Corporation, Eastern Caribbean Bankers Association, and she's currently chairman of the NCBA board. Mrs. Vaughan's academic background spans a BSc in Accounting and Statistics from the University of the West Indies Mona campus, MBA in Banking and Finance from Bangor University, UK. She's also a chartered banker with the Chartered Banking Institute, UK, and an accredited director with the ICSA Chartered Secretaries, Canada. In addition, Mrs. Vaughan completed the Registered Principal and Representative Trading Licensing examinations for the Eastern Caribbean securities market. Charmaine, as we know her, is a wife and mother of 2 children. Both roles, she totally enjoys above everything else. Ladies and gentlemen, let's welcome to the podium Mrs. Charmaine Vaughan.
Yes, so good evening. Persons who know me know I don't like podiums. I don't like to stay still when I'm speaking, so I hope I can move about a little bit, yeah? Yeah, Ivan, I thought I would get some music to wake, you know, because I'm Is it on? Hello? Okay, good. All right, so I am coming last. I begged Jerick to be first, so I don't have to be last on this. And I know it's almost 8 p.m., and I think we were supposed to be here up to 8. So bear with me. I think the topics thus far, all the presenters have done a very good job at basically bringing the topic together. Yeah, I really loved the presentation by Dr. Ram in terms of looking at from a life cycle standpoint, so we really get the context to particularly my presentation, because the two sort of work hand in hand, balancing family, career, goals, financial goals, very important, and all of that will feed into my presentation. I didn't touch a lot of legal. I'm leaving that for the lawyers to do. But again, very critical to part of our decision making around finance matters. So I am going to be talking about family finance makeover. And I see some faces in the room when we did women makeover. Remember we did that women and finance, that makeover for women. And I see the minister nodding, and she has attended every workshop. I can maybe give her the mic to carry that session. So it's nice to be here again with my Anguillian family. So I'm really happy to be here with you. All right. So my first slide speaks to, are we financially fit as a family? How many of us feel that we are financially fit as a family? Our homes. I see more women and a few men. I was hoping to see a more balance. But how many of us feel, by show of hands? Very few, one hand. I'm sure there are more hands. and when we speak about being financially fit, some of the questions, do you know in terms of your income, how you utilize that money that you earn? It may be on a monthly basis, a quarterly, how you manage your finances, and whether you're generating passive income. All of, passive income is what really pushes us into the route of financial freedom. When we start our investments earning, where we no longer have to go to work every day and wait on a salary. So passive income, if we are generating that for our rental properties, our investments, as we said, in stocks and bonds, and a wider basket of financial securities. The next question I have to pose is, I have a $100 note here, US dollars. For some of us, we earn US dollars, some of us earn EC dollars. How many of us know how many of those $100 notes we need to be financially free or financially fit to be able to plan for that eventuality, which is retirement? How many of us know what that nest egg should look like? Show of hands. Do we need 10,000 of those? Is that enough? Do we need 100,000 of those? No. Yeah, so it's important for us as we plan our lives that we try to start to quantify at retirement what that nest egg should look like. Yeah? But a lot of our financial decisions today will help enable us to build those nest eggs and to contribute, that level of discipline monthly and so forth towards achieving that. So I'll put that back in my back pocket. Now, what makes the whole financial planning and really looking at family finances is when you look at what is happening around us. Why is it so important to us as households to really look at our finances? We see what is happening around us. We see what is happening to cost of living. We went through COVID. Remember COVID? COVID taught us a lot. Some of us, we lost employment. We lost our incomes. The good thing, the banks were able to come in and give moratoriums to be able to prevent default in our loan obligations. But what also happened in COVID, it showed that a lot of us, we were unprepared because persons lost, the hotel sectors for most of the region, the sectors closed, hotel workers were out of jobs. What we found too is that from month one, we had persons unable to pay their loans. Why? Because there was not that discipline in terms of that discipline in building emergency fund, and I think Director Ram would have touched on that in terms of building that emergency fund. And emergency funds are really needed, to build that for eventualities like that, loss of income. Yes, so cost of living, we've seen that's on a rise, and that's not just global, and that is driven a lot by the geopolitical happenings that we are seeing. The wars that are happening, you see where energy prices are moving, we see what's happening, when we go to the gas stations now, when we go to the supermarket, the whole supply chain is not just affecting one part of it's affecting us globally. That is driving inflation. Global inflation is now around 3 to 4%. So with global inflation increasing, what it means is that it's going to put more pressure on our dollar, yeah? So today we have to be a lot more cautious. We just came out of COVID. We're now entering, this period where we have to take that whole financial planning very, very important, as an important mandate for us within our households. And as a result of that, with high interest rates, what that means is that the cost of borrowing will also be high. So the cost to get a loan for a mortgage and so forth will also be expensive. And that will also have impact on our ability, to be able to afford our obligations. We will also see, because our incomes will now be under strain, we will also see, our lifestyle being affected as a result, yeah? And then our ability to save. For most of us, we're not even able to save today. And with our incomes under more pressure, that will further impact our ability to save. So be conscious of what is happening globally. When we see those happenings, it filters down. And so we have to be cautious of that. And the result of all of that is hardship and poverty. We're seeing more of that. We are seeing increased rates of default, in terms of obligations, loans, meeting loan obligations, meeting our fixed expenses. We're seeing increased health issues. The biggest cause of health issues when you speak is financial stress. Financial stress is the worst stress anyone can have because it affects you, your health, and so that is why it's important that we take that aspect of our lives as an important mandate. Business failures, and because again more pressures on particularly the small to medium enterprise sector. You will see more failures in that regard because of the cost of doing business and so forth. Now, how do we navigate the cost of living crisis? The key for us managing our families, managing our homes is better money management. And under better money management is really looking at pocket, what's in our pocket versus our lifestyle. What are we earning versus that lifestyle? For 99.999% of people, there's always that mismatch. And unless we don't realize what we earn, is that our lifestyle have to match what we earn. Creating we talk about a survival budget. Because of where we are now, we are all trying to, a lot of us today are in survival mode. We're not striving. And, so that is why our budgets have to be budgets that are developed, take into consideration all of the events that are happening around us. And create a budget that factors that, and again, it has to be adaptive to the environment. So where before we could have set a 12-month budget and go to sleep, and we have to continuously look at those numbers and reforecast, yeah? And so, and even as companies, we do that. Individual households, we have to see it more regularly to relook our numbers. Assessing carefully today our borrowing decisions, and a lot of the demise of a lot of families in terms of our finances really has to do with our borrowing decisions. And we'll spend some time on this. I hope you stay with me, because we have to bring it home. Because it makes the job of the bank difficult when you have the clients that we serve, not in line. So that is why I've spent a lot of the time on debt, managing, the decisions we make around borrowing. I spent quite a bit of time in my slides on that. So what is a family finance makeover? All it means is putting structure, a structured reset to how you manage your household finances. So what you earn, how you spend that, how you saving, your borrowing, and how you teach the whole money management. Because it's a process. And one of the things, and you will see it coming out, that it has to be the entire family, and it came out in the presentations before me, that it is a family effort. It is not mommy's effort or daddy's effort. It's mommy, daddy, and children. When I grew up, I knew from day one, my mother, I was a single parent, every bill in the house we knew. I knew what the electricity, water, telephone, groceries, and what we had to do to generate it. So it taught me from very early. My mother had the family meetings, and from day one she said, okay, as a seamstress, we've earned $1,500 for this month. That's all she was able to, and we have to now spread that in terms of rent, school, pay utilities, it is a lot to cover on that income. And I had siblings overseas at university, and that's earning such a small income. Yeah? But what it taught from very early, the value of the planning to ensure that, you can meet the critical expenses, those fixed expenses like your obligation, your loan obligations. One thing she prioritized was loan payments. She prioritized things that were fixed, that had to be paid, and these were fixed obligations. The variable obligations, you have, leeway to manage that. And then the other thing is to manage your wants and your needs. Sometimes, we have a lot of wants, but do we need it? And that's something she always said, it is not a want, we cannot afford that. But it made life easier when the family understands, the monies that come through a household and how we have to expend it. It makes our life as parents a lot easier because they don't make demands on you. I have 2 children. They don't make no kind of demands on me. My daughter went through, I'm sure you all have heard that story already. My daughter went through 5 years of secondary school. Thankfully, she had small feet. Her feet took years to grow. I bought her bigger size shoes, and she did 5 years of secondary school with 1 pair of shoes. 5 years of secondary school. And the bags, the school bag, she's at UE right now and using her same school bag. She maybe had it from Form 2. They make no demands, and they don't care about John Doe who's saying that you have the same shoes again, Nia? And they keep telling her you have the same. My son now, his feet, the boys, their feet grew, so I had to, change out if the feet grew. But one lesson I taught my children from early, when I buy you a pair of shoes, the only way that pair of shoes is going to be is going to change is if your feet outgrow it. If you go kicking stones, you will go to school with the hole right where the toe is or whatever it is. And guarantee, he did a whole term, at that time I was living in Montreal, he did a whole term going to school with his big toe out because that shoe had to last until the school year, until his foot grew out of it. But these are the lessons. You have to set the standards at home. We cannot have our children not understanding, those, because we may think as these are little things, but these are things that they will carry. Because I carry things from the way I was brought up. And I tell them every day, notwithstanding that I may be able to afford a pair of shoes every term, but I will not be buying a pair of shoes every term. Because there are other things we have to plan for. You see the whole life cycle. You have to plan from the time you are pregnant, your son or daughter. So there's a lot of planning. So that understanding of earning, spending, saving, borrowing, we have to teach our children from very early about those lessons and teach them about money very early. So this is not about restriction, it's not about control, but it's really trying to build a future, a positive future for generations, not just you, but for generations to come. The 5 pillars I'm going to focus on. I think somebody had 5 pillars too. Who had pillars? You had 3 pillars. So the 5 pillars, income awareness. So we're going to be spending time on how do you manage that income. So some little rule of thumb that you and I will leave with you. We're going to talk about smart budgeting, debt discipline, a lot of time on debt discipline. Pillar 4, savings and safety net, and that was touched on as well, and the whole financial education. And that's dear to my heart, financial education. So we're going to spend time on talking on those. So knowing your numbers, every household should know their numbers. That should be, we should be having, and as part of my closing, I have a potential agenda. I will share my agenda with you for my family meetings. But we must, the entire family has to know the numbers, what comes through that household. So they understand in terms of the total household income, where all the sources come from, your salary, wages, commissions, and if you have other passive income, your fixed expenses, you lay it out, all of those fixed costs, your rent, loans, utilities, the variable expenses, your food and entertainment, etc. So all of those expenses, how many of us today know the exact surplus? Because we whether our net that comes to the bank account, how many of us know the details of our income, what we're generating? Please, let's participate. Huh? Yeah, I see a few hands and not all. We need, that's an assignment I leave with you. We need to sit down and put on paper all of the revenue streams. I mean, when you initially do it, you'll get a headache because you'll wonder, all that money I'm making every month, and why am I not able to save? Why I'm not able to, to advance my family's life? So that's a challenge to you. And how many of us know our total debt obligations? How many of us know the interest rate we paying on our loans? Are we getting the best compared to the best rates in the market because we have very good credit score? These are things we have, and we talk about life insurance. How many of us know if we have, based on the type of plan that we have, if we have a whole life plan, whether the plan is actually growing at market rates in terms of the interest rate? Because a lot of those life insurance plans, some of them have heavy cost structures. We have to pay attention when we get our statements, sit down, analyze it, and so forth. Because some of them tell you they have nice savings plans and attached to it. So it's important to understand, pull all of your insurances, your income, your debt obligations, everything, and to analyze that. So smart budgeting, which is the pillar 2. So once you understand your finances, your income streams, your expenses, and so forth, now it's time to build out that budget. And what I call there is a budget makeover. What are the key the key items that need to go into that? Knowing your exact income. We just spoke about sorting out all your expenses. You need to sort it out in terms of fixed. They have the flexible ones, but you also sometimes we forget the periodic ones where you may have insurance you pay every year, but we forget about it. And then we have to come to the bank to get that insurance amount added to our mortgage loan because we have not planned for it. So those periodic amounts that come every year, your house insurance and so forth, those things that we have to plan for those expenses. Figure out exactly how much you spend on each of the categories. So when you're developing that budget, you then plan out, again, looking at historically how much you spend and coming up. And I'll give you some benchmark ratios that you use in allocating that income. Assess your debts, all your loans, as I said before. Assess your spending. So any wastage, that's an opportunity for you to, strip that out and develop a savings goal. Now, one of the things, and that savings goal is what is going to help you build that emergency fund. An emergency fund is so important for each and every one of us. If we cannot be working 10 years and not have, my mother called it vex money. We must have vex money. We are sometimes in jobs and we are unhappy, but we cannot leave. Why? Because we don't have vex money. Now, when you have vex, my mother always told me, when you have vex money, they're stressing you out, girl, get out. Because you have vex money, 6 months of money that can cover your expenses, yes, so that, you give you time to look for something else. Because mental health, if a job you've done everything, it's not working out, most of us have no choice. We have to stick through because we do not have that emergency fund. And not just to leave a job, we're talking about COVID. Loss of employment. You need to have that at least 6 months of expenses saved up. If we are working 10 years, if you're working a year, I don't expect you to have 6 months of savings. The person just start working. But we have to be deliberately contributing that rule of thumb, that minimum little 10%, 5 to 10% of your income. Put it aside from day one and let that grow to build that emergency fund. And you will thank me if you have not started, please, I beg you to start. If you're earning $2,000, you should be saving between $100 to $200 every month. And I can assure you we can all do that. And we'll talk about areas where we can shave in order to do that. And so I'm going to go to that spending, reducing spending. A lot of times you meet with persons and they say, Mrs. Vaughn or Charmaine, I really cannot save. I sat with a sister of mine, not biological sister, but I call her sister. And for months, she cannot save. She really needs us to sit down. And by the time the end of the one session we sat through, I broke down all of her spending. And in the one session, we were able to pull out quite a few of those areas. Eating out. How many of us eat out 2, 3, 4, 5, 6, 7 days in the week? Huh? Show hands. I know we all eating out. I eating out too. Let me raise my hands. Huh? How many of us eat out? Huh? Nobody eating out? Everybody cooking? Huh? Oh, before you were eating out. So now, oh, fantastic. So we have good savings then. Because when I computed, based on, remember for Anguilla in particular, well, apart from the hotel workers, everybody else in the public sector and the banks and so forth, you earn EC dollars. I remember, and I gave that joke at some session. When I came into Anguilla, I come from an EC environment. So I remember going to Chambus, my first week at the bank, with my little $20 in my hand. Not 20 US, 20 EC dollars. And so I saw the menu up, I see 14, 16, I say, ooh, the food looking cheap. And when Mr. Chambu's giving my food, I proudly give him my $20 and I waiting for change. And he's like, no, it's 20, because it was a chicken meal, I think it was 14, but it's US dollars. When I saw a US dollar, I didn't even have enough. So he gave it to me, he trusts me to come back with the difference. From that day on, what do you think I was doing? If I didn't know how to do chicken, I surely knew. So because if you look at, I see some persons even buy breakfast and lunch. So if you average, when I speak, I ask around, people spend on average 20 US a day. That 810 I have there, this is in US dollars. That's like 3 days a week over, and so over a month, look at how much money. Look at how much money annually you would have saved, roughly 10,000. 10 years, 132. And 20 years, 374. But again, you have to factor in, you're buying groceries, it may not be close to that, but think of $810 in US dollars would give you enough groceries, to cut back on, and that will feed a family rather than just one person. Because when you buy, and you remember you have your other family members that are also spending on groceries. This is the household. So if you have 2-3 persons in the household doing that, the mommy and daddy doing this, then it's a lot of money that's going. So if we cut back, we may not have time to cook every day, but if we do in 5 days, let's bring it down to 3 days or 4 days. If we do in 3 days, let's bring it down to 1 day and shave off so that we can. And some people, not that they're not buying groceries, they're shopping and still buying food. And then all the vegetables going bad in the fridge. Are I talking reality? Yes. So what we are doing, we are literally just wasting. Yeah? They're buying fewer clothes, the ladies. We need an outfit for every occasion, everything. If we cut back those budgets, they going out, they grocery shopping. Sometimes we go to the groceries for things, we go for one thing and we end up with things that we should not be buying. But the point I'm making, like my sister that I was helping, I was able to shave on the groceries for her because she had in her pantry a whole lot of expired. She just loves buying bulk. Every month she's just buying and things expiring in the pantry, so we cut back on her grocery budget. We cut back on her, she liked all of the glamour, eyelashes, a lot of what we love, and able to shave and start and transfer those funds into savings. But if you look at this, how much wealth we can create, that nest egg for retirement we can create if we just do a little cutback. Some rules of thumb in terms of savings and investing rule. In order to build those nest egg, we have to be deliberate. And I tell persons a lot, see saving as a mandatory, as an expense. Same way you have to pay your mortgage, pay yourself first. So saving should be seen as a must pay, a mandatory expense. And 10% of your net monthly, you should be allocating. If you cannot do 10, do 5. But every month we should be taking first and we plan the rest. If you plan outside of that 10, you will make do. Yeah? The other area is the emergency fund, 3 to 6 months, preferably 6 months. We work towards building, and as you are deliberate on your savings strategy, you will be able to meet that objective. And the budget guidelines, for that dollar, that income, which represents a whole 100%, that income has to stretch across to cover everything. It has to cover saving, which is mandatory, 10%. You have 90% left, yeah? Housing, for debt, for rent. We have to think that our income, if we earn in X dollars, The rule of thumb is that you should not exceed between 40 to 45% of your income in debt or rental payment. And that's total. So if you know that you want to own a vehicle next month, or in a few months, but you're taking a mortgage today, if you allocate the full 45% to the mortgage, you know what happens? You've maxed out, you know, that allocation for debt. And so what we see happening a lot, so somebody comes to the bank, they get their mortgage very well, and they go on happily, they build their home, everything is nice. Then they come back and they said, okay, I'm ready for a vehicle loan. Salary has not moved. So you've maxed out at the 45. As part of the counseling, we've always advised that when somebody's coming for a mortgage, because it's a long-term, that's a 20, 25, 30-year obligation. We always advise, what are your plans in the next year? Are you planning to get a vehicle? So you leave a small part of that debt ratio to take on additional. We have cases where as soon as they took on the mortgage, then somebody in the family fell sick. So you need a medical loan, but you've already maxed out. And so that is why you see a lot of persons then, if the bank refuses you based on that rule of 45% max in debt payments, they then go to other providers. They pay their loans. They go to the credit unions again, the credit unions do not follow, like a commercial bank follows strict guidelines. So they go out and further extend themselves. So it's advisable that we stick, if we know we're following housing, we need a vehicle loan, or we need vacation, we have a family that love to go on vacation, we leave some of our income to be able to support. Some people like to take their annual vacation loans, and they pay it in 12 months. That works for that family. They plan for that. They plan for that. That's fine. But it has to require that level of planning to be able to achieve all of that. Now, when you own a vehicle, it comes with cost. When you own a home, it comes with cost. A lot of times, when we build homes, and we see it, people build a nice big home, but then the maintenance, you see the house start to run down because they cannot maintain the home on their incomes. So it's important we factor all of that into the equation, because when we do 45% and we still have to factor in another 10% to cover to making sure that property is insured. And one of the things, particularly for Anguilla, we have very low coverage, insurance coverage on property. People, even after it was Irma? Yeah, Irma, you would have thought that people would have been more, cautious in terms of ensuring that their properties are insured. We still have a very large percentage of our mortgage portfolio that is still uninsured or underinsured. And underinsurance is also not good. Yeah? So planning that income, it is so important that you sit down, seek the advice if you're unsure, so that you can allocate those. Because once the decision is made, you locked in on a 30-year mortgage. That's it. Unless if your income increases, then you have some room. Living expenses have to be factored in. If you own a vehicle, transportation, insuring the vehicle, we have persons that only thought about getting that brand new SUV, but they didn't think 12 months later. What happens? Insurance is due. So we must factor in whether we can afford that insurance. Even where there's promotions, 100% financing, and we'll come to an example on that. We can jump for those opportunities, but we have to pause as a family and assess how will that impact our overall finances. I've seen too much in my a little over 30 years in this industry. So debt discipline. Is your debt working for you, or it's against you? And when it's against you, it's really going to be a burden. The worst thing we can do, and what we've seen a lot, is a lot of unsecured loans. People go for these unsecured opportunities. They see it as, I can go on that vacation. But those opportunities, one, erode the equity in your homes. If you do own property, it erodes your net worth. So some people have property, and so you see on the surface they have their own properties, but it is highly leveraged because there's so much debt that they've eroded completely the value of their homes. So it's important that the debt has to work for you, work for your family, and not against you. So why we borrow, a lot of us, we cannot pay for things, from our pocket. There's no way we can build our homes. If we have to, I know some persons that build their homes on their own, but it takes them 10, 15 years, or even buying a property and so forth. If it's on an income, that's why the banks are there, to give you the loans. But so it's important that you understand the purpose of borrowing. We acquiring tangible assets of our life. We want to own our home. We want to buy a car and so forth. That facility is there. We want to build wealth and purchasing those real or financial assets. We borrow to enjoy life. Some people do it. There are people that take the annual loan for not crop over, but not Trinidad, but right here, our summer festival. Oh yes, people take for their costume. Nothing wrong in that. If again, once there is planning, it has, because remember, at the end of the day, life is balance. So if you can afford, your income can afford, that, and you've planned, then there's nothing wrong in those loans. But if you are stretching it to be able to live up to a lifestyle that you cannot afford, that's when it's wrong. To pay for consumer items like cell phones, people take loans for cell phones and upgrading every upgrade. So we have to be careful, with those things. We have appliances and stuff, but again, there has to be a sit down and a plan. Your financial plan, if it's supporting those changes, then at least this is something that's thought through. But most times, this is not the case. People just go, they see the bank has an unsecured loan, or the bank is offering that, they just see money is being offered. We have to pause and we have to be careful. To take care of medical expenses, to pay personal debts, to family and friends, and that's not a good sign, yeah? And to pay insurance, car, house, and so forth. Now, but the question is, are all these reasons good reasons? And there is something called good debt versus bad debt. Yeah, so debt, for me, where I see it, a debt that creates value, that where you're acquiring an asset that has real value, that adds to your overall net worth. Yeah? Your mortgage, your education, real estate, and so forth. All these are value-added loans. You may need a vehicle to commute your family. These are because again, notwithstanding the depreciating value, but it's a value added because it's a requirement for the home. Why? Again, I just indicated that, and now bad debt now is where you take loans for consumption. So there's no value creation. So yes, I've enjoyed my summer festival, and then you now have a loan paying at 30%. And some of those payday loans is 30% the interest rate. When they tell you 2.5% a month, multiply by 12 months, that is a 30% interest rate. So don't just jump, pause, and think through that decision. Bring it home to the family, put it on the table, and discuss. So things that, you just consume. Credit card has its place, but a lot of persons misuse a credit card. Payday loans, again, I hope we have no payday people in the room. But we have to just be careful with our decisions. Unsecured loans, hire purchase loans. We do offer unsecured loans. Banks offer unsecured loans, but these are high-cost debt. Why should you stay away from those bad debts? Because it carries high costs, and we'll see it right here. Look at the cost of those debts. The low-cost debts would be your mortgage, your car loans, your student loans. These are value-added. Then you have the moderate costs, your line of credit, consumer loans. But when you go into the unsecured, the credit cards and the payday, these are the high costs. You see where the payday is? 24 to 30%. You see where the credit cards, if you're not managing that, this is where the cost lies. So all these debts, like a card, a credit card, you have to be able, if you cannot afford, I always tell people the rule of thumb for a card, never take a credit card limit above your net pay. You have to be able to pay off that card. It must never exceed your net pay. And I can tell you that from a personal experience. When I came back from UWI, I was around 23 or 24. I'm joining the bank, when I came back into the bank, I was part of a management training program. First department they dropped me into. I know nothing about no finance, no card, nothing about that. They dropped me in the credit card department. In that department, everybody's saying, oh, I hear about cards and you just get a limit and you can go and spend. And I now come from school, I barely have a proper suit. So I say, oh Lord, credit card, let me have one too. So, as a staff, you ask me what limit you want. I had this one have 5,000. I say, okay, give me 5,000 too. I took a $5,000 credit card, they hand in my hand. Young little 23-year-old. I ain't know nothing about credit card yet. And I went on, what did I go and do? Swiping, buying my suits. Boom, in no time, the card was maxed out. And so every month, all I could have paid, that time my income was $3,152. I can never forget my first salary. When I came back from Europe, $3,152. And I had a card at $5,000. There's no way I could pay that off. I made the minimum payments every month, the little one something, whatever that, percent I made. And every time I get my statement, it moves in like by a little dot. Because if you make only the minimum payment, the balance move in a little dot. Little dot. You have to make extra payments to see a reduction. And so that stayed with me until I had to sit with one of my managers and she advised, and I had to convert it to a loan. And I can tell you, up to today, I have never owned a credit card again. I have no business with it. Now they have debit cards and stuff. I don't want none. So I just using my card, my debit cards, and my only credit card that I own is a corporate from my work, a corporate card that I never asked for, but it was delivered to me. So it's important, but all of that to say, if you stick with the rule of thumb, but the important thing is to settle that card before the due date. So if you know that the card due date, when they calculate the interest at those high rates, you pay off that card before the due date, so that you never pay interest. So some people own credit cards and they never pay interest. They use it, do their purchases, but they have the money to then, so it's sort of a revolving thing. Because a credit card is an emergency fund. When you travel out there, you have that extra, cushion. But it has to be managed properly. You have to be educated on it. And that is why I reinforce the whole process of education. When we venture into something, we must ensure we have the knowledge base. So, once we have that knowledge base, we know how to manage the process. So this is what, so some important considerations to note. Dangerous borrowing decisions that we see a lot as bankers, the long mortgages beyond retirement. We should never have our mortgage or any loan obligation beyond our retirement age. So if we know we are public servant, retirement age is say 65, our mortgage should end at 65. Because what happens at 60? When you end work, that income goes. What kicks in? Your pension. Your pension will not mirror that last salary. So you're moving now from a salary of 5, now receiving a pension of $1,000 something, but you have a mortgage of 3,000. You see how the maths, you know? So it's important that we ensure, unless you have invested wisely, that you know you have passive income. I have my rental, my home, I have 2 apartments downstairs that generating, and so I can afford to pay beyond, but there has to be deliberate planning if you're going beyond. Too many times we see mortgages, you know, go beyond retirement, and there's no income to support it. And what, you know what happens? That loan then drifts after paying it for 18 years and 20 years. You now have, your loan is now in non-performing. The bank now has to foreclose on that loan. So be very careful. Again, planning. We have to sit down as a family. If we go eventually into a mortgage, if we're refinancing a mortgage, because sometimes we're on the right track, but then boom, here comes our daughter's son is now 18, ready to go off to university. We may have to remortgage. But even in remortgaging, we have to sit down and analyze, you know, assess, make the call, Social Security, what my pension will be. You know, don't just do it, just do it blindly. Because, part of our role as banks, we advise clients. I remember one case, maybe a couple years ago, because I'm not into the loan business right now in my current role. But in my past role, we had a case where the mortgage was almost done. So that household was, the primary, the household head was basically 60. The daughter was going off to school, and they came to remortgage. Although the wife was much younger, but the income could not, you know, support. So the primary breadwinner income was key. So, you know, it's only 5 years. Now, because the child was going to the UK or I can't remember if it's UK or US, but going to study management or marketing in the US because they had family there, but paying an exorbitant amount. Whereas the child could have done it right here in Anguilla and take a much smaller loan and be able to pay it in the remaining 5 years. But they remortgaged, took a big loan, and extended, you know, the loan further down because as banks, we tend to go, based on your profession, we can go 67, even as for doctors, we can go longer, yeah, in some cases. But it's important that we advise our children as well, because sometimes our children, they want, my daughter wanted to go to the US to do her medicine. She had all the grand plans in the world. I said, honey, I planned for the education, had the education savings, everything. And when she 18, this is the amount. Now, when we did it 18 years ago, where education cost was 18 years ago, is not where it is today. Although we were able to top up over the years, but she's doing medicine. Doing medicine, even in the Caribbean region, is costing almost $400,000 to do a 5-year program. But she wanted to go to the US, that would have cost around $700,000 because of this, you know, but because her friends were going there, you know, the children, so I had to say, sit down again, refer her down to find the finances of the home and everything else. And then we agreed to K-ville, the lower cost. So we have to guide our children. We have to guide to ensure that, you know, it's in keeping with the overall household finances. And, you know, when we're making those decisions. So long mortgages is a key factor. Long vehicle loans, and we'll see an example shortly, because remember, vehicles value decline. And if you stretch a loan over time, you will end up having balances that does not equate the loan balance, the value of the vehicle. Living on credit cards, again, we spoke a lot about credit cards. Credit cards do have its purpose, but we have to be, it's also an interest trap in itself. Missing or late payments. So where we not paying our loans on time. I had a case, a couple cases here in Anguilla, where persons were late almost every month, late in making their mortgage payments. So they used to juggle when the loan payment, their salary comes, took the salary, and then the second job would pay the mortgage. You know what happened? So by the time the money comes to pay that loan, more interest would have accumulated. Because remember, interest is rolling every day. So it doesn't stop. If your loan is due on the 25th, and you pay on the 10th of the next month, you're talking about another, 15 days of interest. By the time your money comes, the bank collects all of that, what was due and the additional interest. So what happened to this particular client? When we sat with the client, although they were between 16, 17 years paying down the mortgage never moved. So think of you lost 15, 16 years of paying a loan, and the loan principal balance have not moved. And you know why? They very much delayed payment in their loans. So she paid every month by the 10th, 11th of the other month, but that disrupt, how quickly the loan should have declined. So it's important and then plus the penalties for late payments, you also incur that, and it will also damage your credit because we'll know you to not be a timely paymaster. So mortgages also with variable rates. We have mortgages that locked in for 3 years. Remember interest rates, when you get a nice rate today at a 4% interest, remember that's locked in for 3 years. Banks do not offer fixed rate mortgages over 30 years, fixed rate over 30 years. A lot of the indigenous banks like ourselves, NCBA, we tend not to move our rates, our interest rates. But we can't move it because the conditions of the loan spells out that there is a 3-year review. So even if you get a preferential rate today, always ask your loans officer to calculate based on normal rates. If normal rates are at 7% or 6%, find out whether your income can support if rates move upwards. And that's what caused the 2008 crisis. People got, the whole mortgage crisis in 2008 in the US. So it's important that we understand those things when we venture in those areas. So in terms of a quick example, I know I'm way above time. Quick example, should I continue? Let me get should I continue? Yeah. Okay, okay. So Susan Haig got a vehicle loan for $120,000 to purchase an SUV. She got onto that 100% financing, and that's a real case here. 10 years, she took the 10-year option, the longest option, to repay 6%, reducing. Her monthly payment was nicely at $1,300 because she took the long end of that. So it was affordable, her salary afforded it at that rate. But you see what happened? If you see after 3 years, the loan balance at 100% financing without a deposit is at $91,000, that's the balance of the loan. But look at the value of the vehicle. Remember, the vehicle depreciates. Yeah? Value of that vehicle was $61,000 after 3 years. But you see she owing almost $30,000 above the value. And so when we had a jump for 100% financing, again, we need to pause. If she had shortened the tenor to 6 years, you see, if you take in the 100, shorten the term of the loan, she would have been pretty much close to the value, close to the loan balance. But she would have to pay more today. But some people prefer a lower payment and enjoy. I read an article, I think a couple weeks ago, from someone in Anguilla wrote an article about how banks abuse clients in terms of interest. You pay how many homes when you're paying down a mortgage. But remember, at the end of the day, the bank gives you the opportunity for shorter mortgages. You can take a 15-year mortgage. What it would mean? Your payment is higher. So the bank will earn less interest over that because it's only 15 years of interest. But if you stretch a loan to 30 years, you are paying interest to that bank for 30 long years. Yeah? So yes, it's nice to have a long and get a nice small payment so you have more disposable and everything. But also factor in the interest. There's all these calculators you can do to see what interest that the bank is generating. And yes, the bank does generate a substantial amount of interest. Likewise, the bank has to pay out interest, in terms of the depositors' funds. But you have the option to kind of, to manage the term of the loan when you do venture in those areas. What we can do, for all persons registered, we can share the presentations, because I will try and kind of wrap up at this stage. But this is a good example where a household, we would have recommended a consolidation of debts, because that household would have extended themselves. But I believe that you can always pick that up in the presentation. So in the final, some final common mistakes. Not having a budget is always the factor. Because sometimes, because we don't understand our numbers, we do not know our numbers, we end up in those traps. Because we have the false thing that, okay, I think we good for that. But if you drill down into the numbers, you may see then we are not good for that decision. So it's easy to accumulate debt when we don't have a proper budget, and inability to control our spending, making the minimum payments, the high-cost debt, missing loan payment deadlines, not having that safety net, and repeating past mistakes, which happens a lot. We have cases where we would have helped families consolidate debts to kind of give the family some ease. And they go right back and do what? They go right back and borrow. Yeah? So it's like a vicious cycle. So it's important, and that's where once lack of planning, financial planning is, every one of you, we should have a financial plan for our homes. Individually, family-wise, household, once there's income coming together, we have to sit down and plan how we spend that money. So the whole budget makeover must involve the entire family, no matter how small. I would have created a fear in my children. Some people say I should not have done that. But when my children were young, all they saw is mommy writing a check. They writing a check over there, writing a check, buying this, or swiping, in the case when swiping came. And in particular, my daughter, when she was young, she would ask, but mommy, you can just write a check. I'm sure you're experiencing the same thing. You can just swipe your card. And they're thinking that's just all it is. So what I did one day, on my checking account, I placed just about a little under $100 on that account, trying to make sure nothing else is there. And I sent her to the ATM. I said, I told Mommy, you need to go to the ATM, go and withdraw. It was $60. And so she went for me, go and withdraw it, and she came back with the little receipt in her hand. And she sit in the vehicle, and she gave me the $60, and she's like, Mommy, you know you only have $20-something left on your account? And let me tell you, the fear, the worry, but Mommy, how are we going to pay for, but Mommy, but we have all these expenses, how are you going to do these things? I said, exactly, Nia. If you continue to, we don't have the money. Mommy does not have any money, that's all we have now, and we have electricity to pay, so that fear, let me tell you, there was never a request for not a thing. It was about 9 going on 10. Until I have my children, I did the same thing with my son when he was nearing 10. The same exact thing. So they understand the money don't just drop. If you see me going to the ATM, that ATM, they're supposed to have money supposed to be there. It's not a card just swiping from the air, There is money that needs to be lodged in there, and it's not unlimited. So we have to look for whatever lessons, whatever strategies that work for you to enable, and so that whole financial literacy, it has to start from the home. They have to have an appreciation of that. Let our children see our budgeting discussions. Give weekly, monthly allowances so we can teach them. You know, the use of money. You know, that when they're young, we give them those little piggy banks. As they get older, we open their own bank account, take them to the bank. The schools have those savings plans as well. Encourage them to be part of that. Set savings goals. You know, when they want something, you save up for it over a 12-month period. My children don't get anything unless we go on a monthly saving, and then we acquire it. So there's more discipline, and they have more appreciation when they do receive it. Open savings accounts early. We must create a family money culture, and that the only way we can do that is through very open communication. In terms of that's my agenda. Sometimes we tweak it from time to time. We have a monthly meeting of the family. Sometimes we don't spend a lot of time on finances. We just look at, I spend a lot of time on progress, where from a progress, everybody has to give their progress on what they're saving for, where they are in terms of targets and what they've achieved. Look at the expenses, and so the bigger expenses, you know, my husband, myself, we sit down and do a lot of that, but we encourage, we bring them into part of the discussion to help them build their own, manage their own incomes and report on their income and how they use their money. So the whole money education, I believe in money education. I trained, like last week, we had a session at home with my children on crypto, the whole virtual currency. So I'm exposing them to everything, to trading, to stocks, to bonds. We have to educate from early in order to change, you know, because we didn't get that. Remember I told you at 23, I didn't even know how to use a credit card, because we never got that. So the younger faces, when I see younger people in crowds like that, I'm excited, because when you get that information early, to utilize that information to build, to kind of change, you know, shift the dynamics, shift, you know, how we've been managing our homes, managing our families. So let us run our household like how we run in our business. Some of us are successful business people, but when it comes to our home, we don't do a pretty good job. So some money apps, you know, very good apps and there are quite a few. I see every day there are several others in terms of budget apps, or if people like your Excel, some people like their notebooks, whatever that works, utilize that. I love books, money books. I love Dave Ramsey. So Ramsey spends a lot of time, and I utilize a lot of his teachings with my children on the whole smart money, smart kids. That's a really good book. There's it, if you want it in the audio, you can get it on Amazon, as well as the Total Money Makeover, another very good one. And for us women, you know, a lot of us leading in the household, I love Susie Osman. She has a lot of books, you know, to improve our education, our knowledge in the area, and share that knowledge. So storms don't last forever. We may be in a storm, you know, today. We may be in a difficult place today. Financially, we may be battling with our own things. But if we can reverse that by starting. And starting as early is always important, but it's never too late to start. I always end those kind of sessions on the paychecks, because sometimes we feel we have paychecks, you know, our paychecks are limited. Remember our working life. If I have a household, if we are 30 right now to age 65, which is when most of us will move from active work, we have 420 paychecks that we will receive from now to 65. Please, I beg you to make good use of those paychecks, because every month, if you look at by 35, you only have 360. By 40, you have 300 left. By my age group, 180. So you know you're sweating now, and then what happens, you will have to put more than the 10% that we spoke about. That 10% is for the early starters. When you start in late, you will have to contribute a greater portion of your earnings to building that nest egg that you want. So by the time you're 55, 120, by the time you're 60 more, and then 65, the paycheck's gone. And then why you think you pay people in retirement, they have to go and, you know, basically they're still in the workplace. They don't want to go home because they've not planned. We have work, how many of us, we all have a lot of paychecks left, a few more left, no? Let us, you know, restart. Let's reset. Let's begin to work, sit down with our families and rework our strategy around money management. I think that's my last slide. Thank you. Yes.
Thank you very much, Mrs. Bowen. And your presentation reminded me of all the tricks and strategies and techniques I had to use with my daughters to help keep them in line with the budget. So it was a flashback. Ladies and gentlemen, I know it has been long, but I think it's useful. I want to let you know that you will get the slides, those of you who have registered. And also, I think they'll be in other formats, you'll get some of this, because this was very rich. That's why we tried not to stop any of the presenters, because this is a rich presentation. So what I want you to do now is give all the presenters a round of applause. So in a world where economic uncertainty, rising costs, and financial complexity continue to shape our lives, the question is not about whether families should plan, but it's really about how well families should do it, how well they should plan, and how soon they should start. So I want us to I know we have some refreshments for you in a while, but we will take a few questions from you so that we dive right into the meat of this. And I won't do what I promised before and have the panelists debate among themselves. We'll take your questions directly, and whichever panel member wants to field it, then that would be fine. And as you can well tell, it's material that can transform our futures. So questions, anybody? There's someone with a mic on the floor. So questions? Any questions? There's one right here. Yes? No?
Testing.
I was actually going back to my seat, but I'll ask a question. So the first speaker spoke about creating a trust rather than a will. Is there any advice on that? I've always wanted to know how to go about creating a living trust versus a will.
Who was that? Which one? That was you, right? I mentioned, but I think the lawyers better, yes, they're better placed. So one of our attorneys will take that one. Or both of them.
Well, it depends on what your intentions are. If it's in respect of maybe leaving property, I would think it's best to go with a will. I'll tell you why. When someone is holding a property in trust for anyone, they can do whatever they want with it, yeah? They're only liable to account to the trustee for the funds, not necessarily the property. So they can sell it, they can mortgage it, they can do whatever they want with it. But they just have a fiduciary duty to the trustee. That's it. If it is that you intend for the person to actually have the property, it's best you leave it in a will. And even in those circumstances, let's say you die and you don't have sufficient money to pay your debts, the executors may still have to sell that property in any event to pay your debts, and then whatever is left, the beneficiaries can get. Which is why I kept mentioning the life insurance policy, to cover your debts, so that way you can actually leave whatever property you want to leave to your different beneficiaries. So as a trust, they can mortgage it. It's all legal. They can mortgage the trust property. They can sell it. They just need to account for the value of it. So it depends on what you want to do. Yeah?
But you, okay, sorry.
No, sorry, thank you. I also think it depends on what it is you have in your estate, because this is taking the assumption that the estate only consists of real estate, but you may have cash, which may be another incentive as to why you want to create a trust. So I think I totally agree with Tony, in that if it's real estate property and you want to transfer the real estate property outright, the ownership to the recipient, the beneficiary, then a trust may not be the proper tool for that. But if it is that you want to create wealth that you want to put in a trust, and then determine how you want that wealth to be dealt with beyond your life, then perhaps a trust may be an option for you. But there are two factors. Like Tony said, what is your intention, whether it is to transfer ownership or what the estate has, and how you draft that trust, and how you prepare that trust, what it is that your intent is, and how is that drafted into your trust so that the trustees can then carry out your intention. Because they have to do that. They have to carry out your intention in order to, so that the beneficiaries can benefit from what you intend to do.
I think the thing that attracted me, I guess, like you, is when they said, hey, listen, with the trust, you don't have to pay that ton of money with the will transferring, and it's easy. But now you all spin it back that it's not necessarily as easy as we think. Yeah?
No, it's the intention.
The intention.
So just,
This legal thing, you see.
just to add to the whole trust. So in my current role of my bank, we offer trustee services. So we are a trustee, and one of the areas that and I think you mentioned, Keisha, is if you want to create long-term wealth, like over generations, you may have cash. You have wishes for your family, what you would like to see for your family, if you have children, their education, and so forth. So you actually, in your wishes, would spell out how would you like the trustee to carry out even after you've passed, yeah? So in a case like that, you have with a will, when the cash is passed on, the beneficiaries of that can just spend how they want to. With a trust, the trust can go further to actually basically break down the distribution, how every year you distribute to cover tuition, you pay X amount to my surviving spouse, and so forth. So the wealth carries on for a longer period. So your children, because a lot of times we work our whole life, you leave monies for your children and they use it up in no time. So a trust, if you want to really secure more long-term, that will serve a better purpose in creating a trust, and having a trustee manage your wishes over a period of time.
Okay, thank you. Any other questions? Yes, there's one right here.
Good night, everyone.
Good night.
My question is mainly for Mrs. Charmaine, and it is pertaining to savings. So we all know that Angola is officially an EC country, but from what I have observed, a lot of people, if not most people in Angola, use the US currency. Do you believe that obtaining US versus obtaining EC affects the way that people in Angola save their money?
Say that again. Yes, I didn't catch it.
Do you believe that people obtaining the US currency versus the people who obtain the EC currency, it affects the way that they save their money in Angola? So for example, if I get US from my dad, I normally spend it faster than I would with EC.
Oh, okay.
Yeah.
So
okay.
yeah, that's my question.
So okay, but that's a very valuable
That's
point, because
interesting.
when you look at in terms of consumption here, prices apart from supermarket and government offices and so forth, that's EC dollars, but everything else, restaurants, everything is US dollars. That's what we in terms of consumption. So I can understand what you're saying. You get the US and you just use that to consume. Now, we have to, again, it boils down to your earning. If you earn in EC dollars, because the people that earn US from the hotel is dollar to one for them. Yeah, so I'm earning 3,000, I'm buying a meal at 14 US, is dollar to dollar. But if you earn in EC 3,000 and you're buying a meal at 14 US, this is not dollar to dollar, one-to-one, arrangement. So you have to exercise care in terms of, all those monies that daddy gives you, compute it to EC, look at what that represents in terms of your income. Are you working now? No? Oh, so it's just your allowance, yeah? Yeah, so boil down to, at the end of the day, look at the total and see how you spending, whether you spending prudently, regardless of which currency. You still have to, to compartmentalize and say, okay, this is what I should spend on that, this is what I should spend on that, if you want to convert it to EC, or you may want to leave it in US. Yeah?
When you mentioned the term, I think savings discipline and spending discipline, those two things, yeah, I think is where you hold it in. Any other questions, comments, emotional outbursts, anybody? Going once, going twice?
Yeah, over here, sorry.
Good.
So someone would have pointed out, based on Dr. Ramzan's presentation, as it relates to investment options that are available, and we should take advantage of those. Some of the public would say at this point in time, there are some investment options or platforms which allow clients to invest. However, certain banks it seems like regional banks within the region are blocking the usage of certain platforms or whatever the case may be. What are some options that you know are acceptable at this point in time, given that?
This one works? Yes. Not on. Sorry.
Okay. Yeah, it's a very good question because some of the internationally available platforms, like for example, some banks don't allow you to trade in crypto quite easily. You try to register onto those and then you try to buy crypto using your credit card or your debit cards from your regional banks and it's blocked, right? At least that was the case up to a few years ago. I'm not sure how much of it has changed now. But there are, of course, other legitimate platforms that one can consider utilizing out of the US, for example. I mean, people speak about Robinhood. If that certainly is one that's available that allows retail investing into the stock market in the US. Are those the types of investments that you are interested in and that you are speaking about? Like investing in the stock market overseas?
Hello? Okay, yeah. It will be a mixture of crypto and also stock.
One thing I would also say as well, you can find sort of consolidated investment vehicles as well. I'm not sure if it's available here, but in some countries you might find a mutual fund that is investing in emerging markets or a mutual fund that is investing in US stocks. That's a way to sort of manage your risk because now the mutual fund is doing what you want to do, but pooling resources from a number of investors to do so. And I think that's a nice way to try to bridge the risk that you might have as an individual on your own. Find a mutual fund that's investing in the type of assets that you are interested in. Emerging markets, okay, find a mutual fund in the US that might be doing that and buy into those shares, for example. That sort of helps you manage your risk. And I think that sort of thing is also quite acceptable to your local bank because more than likely your money is going from your bank to another intermediary in the US, for example, and so the monies are traceable. So there's some ways to try to mitigate the risk that some of the regional and local banks might be interested in, but that's some way to get over it as well. Yes?
Okay. One more thing, in regards to that same topic, some of the issues also that some people may also face in that regard as well as they may try to register for these platforms, they require a U.S. tax code number, whatever the case may be, because, you know, the framework right now, they want to make sure they can claim tax on these trades and these investments. So that's another blockade a lot of people have, and obviously we don't have a U.S. tax code. And I would also like to say as well, in terms of Anguilla as a country, as an island, it does not register on most platforms either, are identified as even in existence. So that's something we as a country could kind of walk on and get in that kind of footprint, digital footprint, as relates to trading, banking, etc. That will be really good. I know one of the issues maybe is that we're on the EU list. I think that's the only sanction that we have right now currently. Correct me if I'm wrong. Through my own research, the only reason why we're on that list is because we do not have an income tax. Through my research, I could be wrong.
Okay. Yeah. All right.
I actually have a question, if I may.
Yes, sir. Go ahead.
It's a little bit might be a little bit off topic, but I see a few young people in the crowd, and this, a number of persons on the board for NCBA, so I'm not putting you in hot water. But the young people today are looking for a lot more options to make income residually or otherwise. And with the advent of AI, sites like Fiverr, where they can use their skills designed for anybody around the world, we have a problem in Anguilla where they can't accept payment. They can't accept PayPal payments and the like. So our market here is so small, the options for employment are so limited, they are seeing the world go beyond them, but they want to be home, and banking presents a challenge. What can be done for young people or anybody who wants to go to venture out a little bit more from the safety of their nest, so to speak, and explore entrepreneurial opportunities, whether they design, whether they make crafts, sell them online? It's going to be a bit difficult for them. If somebody makes some bracelets, they can't export them and accept payment. They could only deal with the limited market here. So for the young people in the crowd, what's the bank looking to do for them so they can build their own nest egg from now?
Thanks for that. That's a problem in all Eastern Caribbean countries, all of them. You're going to answer this one? Oh, okay, good. Anything?
It's a problem for most of the, in the Eastern Caribbean in particular. And it's an area that we definitely have to put some work into. Particularly if they, I don't want to repeat what you just said. But a solution right now, so what are the platforms that are being used now? So it's just PayPal, you're saying, and their challenges utilizing?
Venmo, PayPal, Venmo.
Oh, Zelle, all of these platforms, challenges with all those platforms?
So it will be Revolut, Wise currently has issues. PayPal, you can only send, you can't receive. Payoneer used to work, doesn't work anymore. So
the option now is, because of some banks, some institutions are actually going directly to those players and setting up, relationships to sort of open up the channels for, for our clients. So Resolute, for instance, they are actually approaching Caribbean banks now to actually act as a correspondent bank for those regional banks. So in time, we'll see that changing. I'm surprised PayPal is an issue still. PayPal is an issue?
To receive,
wow.
to receive. Online work,
Okay.
You cannot receive for some things, but
on that particular,
But
it's something that we will have to
look into.
What
some youngsters in the Windward Islands, what they do, they open US dollars account, but not everybody can do that.
Not everybody have a US.
What I was wondering is if the bank offers you a chance to open, because some banks offer you a chance to hold an account in a foreign currency, whether that would work, I don't know. I have no idea.
So where you have, like, for instance, I don't really want to, I didn't come here to market me or...
Okay.
But there are options in the region that, outside of the OECS. Outside of the OECS, like, for instance, the private banking space has a lot of options because of the international, that international presence. Yeah, but domestic banks, it tend to be a little more difficult for them, domestic banks. Yeah, but it's something that we will definitely, put on the table and discuss. Because if there is a market, we have to create solutions for those, that type of creativity to kind of push that. But I just want to touch on quickly to Dequan's point. There are, and to kind of add to what Dr. Ram has said, there are mutual funds right here in the region. For instance, the Eastern Caribbean had some challenges in the early implementation of the ECSE. The regulations were changing about in the last 5 years to allow for, ease in setting up collective investment schemes or mutual funds. So since the changes in the legislation, we've had Bank of St. Lucia, in St. Lucia, they have a mutual fund, quite a few funds that gives you access to international markets, emerging and developed markets. as well as you also have Unitrust Trinidad, who's known for mutual funds. They've expanded into the EC, Eastern Caribbean. So you have quite a bit of broker-dealers that sell the Unitrust mutual funds that any of us can tap into, yeah? One of the things, early days, but we as a bank, as a board, we are looking to expand into the wealth management space to be able to offer clients access to those markets, to those instruments and so forth. So it's something that will come, very soon. But even if you're interested now, don't limit yourself. There's also the stock exchange, the Eastern Caribbean Stock Exchange, nothing fancy, but in terms of, there's about 13 or 14 stocks trading on that market, not a lot of activity, but explore, see what's there. But the mutual funds, for instance, there's access to mutual funds for anybody registered or living in the Eastern Caribbean space. Yeah.
Just one other side from what I was speaking about again. So I know one of the things that persons have been trying to do is create some payment gateways, right? And that has its challenges with Visa and whoever else, you go through all the loops. But for the micro, small, medium size, the SMEs, would the bank be, this might be on the spot, would the bank be willing to tailor some sort of solution, whether it be with the rate that you're charged on these transactions, and otherwise to make it profitable for somebody like the young people, again, when they're setting up themselves, build a website, put the payment portal into it and go that route as opposed to going the PayPal route or something else. Just go the full business route. Make sure that they get licensed and meet with the lawyers and set up themselves properly. Can it be more attractive than for them to say they're going to go out of pocket $5,000 before they make $5?
So tell me what would be attractive, because I know...
well, this is what...
I know the bank does have the SME offering in terms of, again, the interim CEO, Jerry, correct me, maybe, if you can speak on that, but I know the bank does have special rates for SMEs. Okay. So particularly small, the small enterprises, like startups and so forth. Mm-hmm. I think the bank would be willing to support and look at a structure for those clients. Jerry, again, I'm guided.
Sorry, I think what he's really trying to say is to offer a holistic package. Correct. So not only just financing, but also creating that assistance with a website for them to actually receive money. So for example, if I have a business that sells, well, I'm a musician also. So if I want to offer certain music skills to someone overseas, they could go to my website, they could pay for tracking or whatever the case may be, so I could work with someone from St. Vincent, Grenada. Because personally, too, that was an issue for me as well. Somebody wanted to do some business with me, and they couldn't get paid. So...
The bank does that now, in terms of supporting payments on websites.
In terms of putting it in one package deal.
Can I make a recommendation? And it's not really from the banking perspective, but more from legal, and just kind of like advising startups. And in my experience, perhaps you may want to consider looking beyond Anguilla for the support to set up what you're looking for, and then come up with a solution that you present to the bank. First of all, the SMEs, there needs to be an organization or some kind of one voice is not going to send the message loud enough to the bank. It's not going to have the impact that the bank needs to receive in order to make the change or to give you what you're looking for. But there are a lot of organizations within the region that offer the support and even granting to small businesses that need the funding to take to the bank to get the start going, to set up your business plan, to incorporate, to pay that initial advice for your IP protection, if I must add that, and also to organize your website, to perhaps look into some kind of payment platforms that you need, there are organizations in the Caribbean region that do offer that service specifically for small businesses. And maybe you want to look outside of Anguilla for that support and then come with that voice and the funding and the granting to the bank with a plan, because once you bring the plan to the bank as an SME, the bank is going to be willing to have that conversation. So I think you have to look beyond just coming one-on-one as an SME, as someone who's selling bracelets or someone who's selling T-shirts or whatever it is. There are a lot, if you go right next to the St. Martin, St. Kitts, Dominica, those islands have very small businesses that are doing very well for that reason, because they're getting the granting that they need to get the kickstart to start up.
Okay, that's it. Going once, going twice, going 3 times. All right, ladies and gentlemen, I really appreciate your endurance with these 4 presentations. And at this time, we're getting to close. And the only thing standing between us and the refreshments is our vote of thanks and closing remarks, which I'll call Mr. Vishal Jadoo to make. So thank you, panel.
Good night, everyone. Thank you, Mr. Murillo. I'd like to thank Culture Concepts, Titanium Audiovisual, Black Orchid Forest, JTR Security, the Ministry of Infrastructure for the floodlights, and some individuals that helped prepare for tonight: Sandra, Brian, Ms. Brown, and Jarek, our receptionist ladies, Stanisha and Candisha, Ivan and Shama, Mr. Murillo, our panelists, Mr. Ram, Ms. Vaughan, Ms. Fleming, and Ms. Simpson-White. And finally, I'd like to thank each and every one of you for coming out and supporting NCBA Family and Finance. Thank you. Yeah, that's it. So, I'm sitting here.
Sustainable growth and real results. 10 years on, that commitment stands stronger, measured in milestones achieved and lives impacted. From one generation to the next, we've grown together. NCBA is more than banking. It's the trust in your first savings account, the courage to start your own business, the dream of owning your home. We belong to Anguilla, to its people, its families, its future. And as we look ahead, our promise remains to serve, to lead, and to grow with you. Banking where you belong. The National Commercial Bank of Anguilla Limited.